Hello friends, welcome to my YouTube channel. Today we will discuss about bonds versus stocks, a beginner's guide. Stocks and bonds are often paired together when talking about investments, but their risk, returns and behaviors have stark differences. What's the difference between stocks and bonds? Stocks gives you partial ownership in a corporation while bonds are a loan from you to a company or government. The biggest difference between them is how they generate profit. Stocks must appreciate in value and be sold later on the stock market, while most bonds pay fixed interest over time. Here's a deeper look at how these investments work. Stocks Stocks represent partial ownership or equity in a company. When you buy stock, you are actually purchasing a tiny slice of the company. One or more shares are the more shares you buy, the more of the company you own. Let's say a company has a stock price of $50 per share and you invest $2,500. That's 50 shares for $50 each. Now imagine over several years the company consistently performs well because you are a partial owner. The company's success is also your success, and the value of your shares will grow just like the value of the company. If its stock price rises to $75, a 50% increase, the value of your investment would rise 50% to $3,750. You could then sell those shares to another investor for a $1,250 profit. Of course, the opposite is also true. If that company performs poorly, the value of your shares could fall below what you bought them for. In this instance, if you sold them, you would lose money. Stocks are also known as corporate stock, common stock, corporate shares, equity shares, and equity securities. Companies may issue shares to the public for several reasons, but the most common is to raise cash that can be used to fuel future growth. Bonds are a loan from you to a company or government. There's no equity involved nor any shares to buy. Put simply, a company or government is in debt to you when you buy a bond, and it will pay you interest on the loan for a set period, after which it will pay back the full amount you bought the bond for. But bonds are not completely risk free. If the company goes bankrupt during the bond period, you will stop receiving interest payments and may not get back your full principal. Let's say you buy a bond for $2,500 and it pays 2% annual interest for 10 years. That means every year you would receive $50 in interest payments, typically distributed evenly throughout the year. After a duration of 10 years, you would have earned $500 in interest and you would get back your initial investment of $2,500 too. Keeping a bond for the full duration is known as holding until maturity. With bonds, you usually know exactly what you are signing up for, and the regular interest payments can be used as a source of predictable fixed income over long periods. The durations of bonds depend on the type you buy but commonly range from a few days to 30 years. Likewise, the interest rate, known as yield, will vary depending on the type and duration of the bond. Want to get started? Learn how to buy stocks and how to invest in bonds. Comparing stocks and bonds. While both instruments seek to grow your money, the way they do it and the returns they offer are very different. Dive deeper. See how stocks and bonds might fit into your asset allocation. Equity versus debt. When you hear about equity and debt markets, that's typically referring to stocks and bonds respectively. Equity is the most popular liquid financial asset, an investment that can be easily converted into cash. Corporations often issue equity to raise cash to expand operations, and in return, investors are given the opportunity to benefit from the future growth and success of the company. Buying bonds means issuing a debt that must be repaid with interest. You won't have any ownership stake in the company, but you will enter into an agreement that the company or government must pay fixed interest over time as well as the principal amount at the end of that period. Capital gains versus fixed income. Stocks and bonds generate cash in different ways to make money. From stocks, you will need to sell the company's shares at a higher price than you paid for them to generate a profit or capital gain. Capital gains can be used as income or reinvested, but they will be taxed as long term or short term capital gains. Accordingly, bonds generate cash through regular interest payments. The distribution frequency can vary, but it's generally as follows: Treasury bonds and notes every 6 months until maturity, treasury bills only upon maturity, corporate bonds semi-annually, quarterly, monthly, or at maturity. Learn more, read about the different types of bonds and how to buy them. Bonds can also be sold on the market for a capital gain, though for many conservative investors, the predictable fixed income is what's most attractive about these instruments. Similarly, some types of stocks offer fixed income that more resembles debt than equity, but again, this usually is not the source of stock's value. Inverse performance. Another important difference between stocks and bonds is that they tend to have an inverse relationship in terms of price. When stock prices rise, bonds prices fall, and vice versa. Historically, when stock prices are rising and more people are buying to capitalize on that growth, bond prices have typically fallen on lower demand. Conversely, when stock prices are falling and investors want to turn to traditionally lower risk, lower return investments like bond, their demand increases and in turn their prices. Thanks for watching my videos and stay tuned for next video. Thank you.